at an exceptionally elevated level, I'd mention that there are numerous hardships, an array of obstacles. We'll delve into all of them comprehensively. People attribute statements to you and tend to characterize you as a pessimistic and bleak individual. Jim Rickards is consistently discussing the apocalypse, which I never do. I never utilize that phrase. But I do emphasize that despite the challenges, we don't have to be powerless victims. We don't need to retreat. The crux is anticipating it. If you can foresee things, you can handle them accordingly. You can navigate through them, not only safeguarding wealth but actually generating profits. I frequently highlight the case of Augustinus, and people ask, who's that? He was an industrialist in Weimar Germany during the early 1920s and could foresee the hyperinflation much earlier than the middle class, much earlier than anyone else. He proceeded to borrow a substantial amount of Reichsmarks, the currency at the time, and simply invested in industrial assets, coal mines, vessels, natural resources, and so forth. So when the hyperinflation hit, he waited a bit, repaid his debts. I'd say it was pennies on the dollar. To put it another way, an infinitesimal fraction of a penny on the dollar. Nevertheless, he repaid it. Even though they were practically discarding the money, he settled his debts and retained all the assets, ultimately becoming the wealthiest man in Germany. And my German is not very proficient, but his nickname was the Inflation King. There are other narratives akin to this Joseph Kennedy in the 1929 crash. But here's an individual who lived through the most significant hyperinflation of any contemporary industrial economy and emerged as the wealthiest man in Germany because he anticipated it and made the right move. So, again, we're not powerless. We can take action about it. But the crux of empowerment, as I say, lies in predicting it. That's where the analysis comes into play. And you might ask, gee, Jim, are you more intelligent than everybody else? Certainly not. There are plenty of brilliant minds out there, but they have flawed models. There's substantial behavioral psychology behind recognizing the confirmation bias or believing that the future will resemble the past, which it often does not. Hence, if you adhere to those models, yes, you'll obtain very poor results. It's challenging to think of an institution with a worse track record in forecasting than the Federal Reserve, the U.S. Federal Reserve perhaps except for the IMF. They're both quite poor. I mean, you could almost take the Fed's forecast, do the opposite, and be just fine. There's more to it, but they steadfastly adhere to these really flawed models. But if you comprehend how the economy truly operates, if you recognize it as a complex dynamic system, all I've done is applied complexity theory, which has been around for a while. I mean, you could trace it back 13 billion years because the Big Bang was the ultimate complex dynamic paradigm shift or phase transition. But the scientific understanding of complexity, articulated in mathematical terms, really dates back to the early 60s, but it's been effectively used in physics and has various applications. All I did was transfer it to capital markets. I observed capital markets and thought, wait a minute, here's one of the most complex dynamic systems imaginable, and then there's nothing more intricate than the human brain. So when you superimpose humans atop capital markets, you've got complexity squared or some exponent. And those models function splendidly, but convincing anyone to comprehend that or carry out that work is arduous. But, once again, the point is, with the right models, and I would include behavioral psychology, a solid dose of history, complexity theory, and a few other branches of applied mathematics, you can achieve excellent results. However, if you adhere to the Phillips curve and non-accelerating inflation, the unemployment rate, and numerous other fallacies the Fed uses, yes, you'll get it wrong. Does the future mirror the past? To some extent, with a probability, a degree distribution probability. Not always. I mean, perhaps less frequently now than ever. And they also assume that prices move continuously. Prices ascend and descend, of course, but markets do not move continuously. Or if they do, it's when you're not paying attention. When you are attentive, they just leap. They leap down or leap up. You miss it, you blink, and it's at an entirely different level. It's been revalued. Now you can still enter and exit, but you've either amassed a significant amount of money or lost a substantial amount of money in an instant. So when you factor in those characteristics, this is how I initially started deconstructing it, if you will, and say, well, look, markets are not efficient. That's nonsense. They don't move continuously and gradually. They leap up, they leap down. And if you're not prepared for that, you've missed the opportunity. Nothing is devoid of risk, so why don't we start from there? When I began identifying those factors that, in my opinion, were erroneously applied, and you say, well, what resembles that? Well, the answer is a complex, dynamic system, a system that generates hurricanes, tornadoes, lightning bolts, power outages, earthquakes, and tsunamis. Those are all manifestations of the outcomes of complex dynamic systems. An earthquake doesn't sneak up on you. The ground falls from under you instantly, and that's what occurs in markets. So then I thought, maybe that's a superior model. Of course it is. Things are constantly evolving. Another tool, an intellectual tool, an applied mathematical tool, utilizes Bayes' theorem without delving too much into the intricacies. And I learned Bayes' theorem at the CIA because I always say, if you have all the facts, a smart high school kid can solve the problem.